Hello, this is Adrian Day with another of our video highlights. If you'd like to learn more about the topic that we discussed today, you can watch the full interviews on our website at adriandayassetmanagement.com, where of course you can also find more information about our services. Sit back and I hope you enjoy. Thank you. I'm still very bullish, but we have to recognize that after what's happened in particularly since August, where gold has just, done a moonshot, as it were, gone way, way, way above trend. And the trend was already pretty sharp. One has to recognize that there's a potential for a pullback. If you look at gold itself, look at gold and look at its performance. There's no question in the last 2 months, gold had gone up too far, too fast. It had been, I like to say it was overbought but underowned, but it was clearly overbought. It had gone up too far, too fast. But look at a long-term graph and look at it in a log term. Look at it in a percentage term. This rally over the last year and a half in gold is less than the 2010-11 rally, and it is less than the 1979-1980 rally. So, I think if we look in this in context, yes, this is absolutely, the last 2 days we've had absolutely very sharp declines. But if we look at it in context, I'll say a few things. First of all, you said, we're only back to where we were less than 2 weeks ago. And if you look back, whether it's 2020 with COVID or 2011, 2009, 2006, we've had declines similar to this in the past. This is not, I've heard people say unprecedented. This is not unprecedented at all. I don't think gold is overvalued. It's very difficult to value gold because you can't value gold in the same way that you value a manufacturing company, where you look at revenue and expenses and cash flow and dividend and book value. You can look at gold on an inflation adjusted basis. You can look at gold relative to all the debt in the world, gold relative to all the money supply. You can look at all of these things. Gold relative to the Dow is a very popular way of looking at it. You have to look at it relative to something else. It's difficult to analyze gold itself as you can analyze, Nestle, and say, it's expensive on a book value. It's expensive on an earnings basis. It doesn't have earnings. But if you look at a gold versus the Dow, for example, it's definitely not as undervalued, no question. It's not as undervalued as it was 5 years ago. But on a 100-year basis, on a 50-year basis, it is still above the average valuation. And a long way from the point where the Dow gold ratio bottoms, right? And gold is at the top, like in 1980. And gold stocks, the same thing. Gold stocks are still trading well below their long-term average valuations. And in fact, in some cases, on some metrics, they're trading pretty much at their lowest multiples ever.
Yeah, perhaps a generalist investor is a better term. So 3 different buyers that we've seen recently, of course, central banks, wealthy gold buyers, and then now the generalist investor. Looking at perhaps past parallels, historic parallels, how long could this cycle really last if you have those 3 buyers behind the gold price?
Yeah. Well, you know as well as I do, I hope you know, I hope people know that gold cycles tend to be long. So, and obviously you can determine based on corrections where you start and stop your cycle. But just look at the last cycles. We went from 1971, which was an artificial start because that's when gold was freed. But 1971 to 1980, that's a decade. We went from 2001 to 2011. That's a decade as well. If you go back over 300 years, you find that gold cycles up and down have tended to last for between 15 and 30 years. And so what I would say the big difference between today and 2011 is the sentiment. So again, precisely the fact that in 2011, everyone was doing M&A like crazy. In 2011, you were getting new deals coming to market every single hour of every single day. In 2011, the GDX was trading at a premium in June, July, August, September, and that premium was growing as the market was topping out. In 2011, you had huge inflows into the GDX. So if we're looking at gold as investment, it's interesting. We're certainly seeing more interest. We're certainly seeing more interest in the last month than we have for the rest of this year and before. So we're definitely seeing a shift in interest. We're seeing it in our asset management. For example, we're getting a lot more queries, and we're getting new accounts open. If you talk to coin dealers, whereas 3 months ago they'd say, we're so busy, we've never been busier, but 3/4 of the people calling us are selling, not buying. That shifted a little bit, but it's still no overwhelming rush that you would expect at these prices after gold has done what it's done. It's not what we saw in 2011. It's not what we saw in 2006, 7, or 1996. The ordinary everyday retail investor, it would appear, is simply not looking, and if anything, they're using this as an excuse to take money out. Frankly, my position right now, after gold, as you say, has come from 4,400 to 4,000, and the GDX is down, I don't know what, about 12%. My position right now is for people who are reasonably fully invested, like a gold client who's got 80% invested in gold, or a conservative account who's got his full allocation in gold, we are not adding to it right now, because I think it's a good idea to always keep some money in reserve for in case the market goes down more than you think. I would say that if you're new to this sector, if you are meaningfully underweight, I talked to a person today who said he had sold his entire gold portfolio 3 weeks ago, which is pretty close to the top. If you're in that kind of position, I would definitely say start buying.